Hello, everyone. I'm excited to kick off this first panel on financing innovation in China, which is one of the more exciting topics because we all have to know who's going to pay for it, and if it works out, who's going to profit from it. I'm Martin Chorzempa. I'm a research fellow at the Peterson Institute for International Economics, about a block away, and I focus on financial innovation. But we have a fantastic panel here. I'll go with just brief introductions to them and then move into a lively and fruitful discussion. We have Michael Kuan of Kuan Capital, who is an investor. So we have all of the facets of this question from the people who, like him, who are evaluating the potential investments in innovative companies to deploy their capital. We have Joyce Chang from JP Morgan, who's going to be looking more on the macro side and has an overall picture of innovation in China. And then finally, we have Vincent Mo, who's on the other side of the table from people like Michael, trying to raise money for entrepreneurial ventures. I'll kick it off with the first question, which is about, more broadly, how exactly is China's financial system working to finance innovation? If we read the media these days, everything seems to be about deleveraging and the private sector, innovative firms being unable to receive funds from the riskier channels they got them from in the past, but also not from the banks. But then there are also these other interesting channels and developments in venture capital, PE, and potentially high-tech board. A lot of interesting things going on. So how do you assess the overall ability of China's financial system to finance innovation, and is it getting better or worse these days? We'll start with Michael.
Good afternoon. That was a little tough. Actually, I think Chinese financing activities go around the cycles. And so we're in a cycle of realizing that not all innovation makes lots of sense. So there you see some activities pulling back, valuations coming down. Stock market went down, but this year went up 25%. So, so there is actually realization of when the economy, actually Chinese economy is slowing down, what is substitute for the next growth engine? And the consumer spending is one, but I think every country is talking about innovations. But innovation takes time. Innovation not always bring new growth engines. So I think China is in that stage, realizing that what kind of innovation we need, whether it's mostly consumer-oriented or digitalization for consumers, or we want to do a more industrial, smart manufacturing, or EVs, or automobilities. So I think we're in this down cycle, which is good for investment, so because the valuation is coming down a little bit. So I think it's a quite healthy correction for the long run. The market still have lots of money. The market, stock market, the capital markets, there's still lots of VC funds and private equities, and the local government's really doing lots of financings. I think in the long run, China's capital market is still very, very important for innovations.
The second question is looking at the funding structure and exits. So one of the more interesting phenomena has been that the successful Chinese tech companies seem to always list in the United States and not in China, and that the dirty secret there is that these foreign investors often make a lot of the money from the successful Chinese companies, both in the VC PE side, but also in the listing side. Do you think we're going to continue to see successful Chinese companies listing abroad, like in the United States, or are they more likely to, because of the move with the high-tech board and some of the other changes in China's IPO structure, that they'll be able to actually list and successfully raise larger rounds of money in the mainland?
I think we did the first listing. Not we, I was a part of it. It's called China.com. So we brought internet to China, and there was the company listing in the United States. But because we had that time, that was not the VIE. structure. I don't know if people know the VIE structure. China, there was a creation for companies outside China to supply technology to Chinese companies because internet that time cannot be operated in China. So therefore, you have some contractual agreement, you listed the technology arm. That's called a VIE. And I think Sina next. I think you're probably VIE as well, right?
We have the same structure.
That kind of structure actually allowed foreign investors to make investment, at the same time to allow certain sectors China were not allowed to, that time operating, to be listed seeking capital in the United States. A very, very creative way of doing things, which what I think is one of the biggest innovation. I think it continue, there's still going to be good companies come to the United States. It's a mature market, and I think overall it's much more healthy than the Chinese market. So that's why Alibaba is here. It's not in China. But I think they are talking about in China now to also has this reform, and so therefore we probably for the first time we're going to have so-called market that you don't have to be proved in order to be listed. If underwriter wants to take you to IPO, you can do it, and we're trying in China. I think that's going to be encouraging some kind of listing. I just met someone from US, and he's part of shareholders, going to be first listed in China. I think it's good news. But I think overall, companies just want to get to the market where they can access to funding, reputation, or cash out for the owners, and it continue to raise lots of money. I think, Vincent, your company, if not listed in the United States, you're not going to raise $1 billion in China, I guess. And even if you raise $1 billion in China, you have so much restrictions of how do you spend the money on that. I think China is changing on that, and I think eventually, I think Joyce, you can comment on that. Eventually, I think Chinese market is going to be given some years to catch up with where the United States is going to be. So we have some hope on that.
So shifting gears a little bit and connecting to some of the earlier discussions about US-China, much of what's been on investors' minds these days is changes in the investment regime, beefing up of the CFIUS, potential export controls from the United States on emerging and foundational technologies, but also China trying to make sure that some of its technologies are not taken out. Is there generally a sense that as an investor, there's a not for sale sign on American tech firms? If you're an investor from China, are we still going to be able to have this kind of cooperation with VCs, and now that FIRMA and CFIUS are able to have jurisdiction over non-controlling investments, how do you see this changing the financing of investment going forward between US and China?
So speak?
Yes.
Okay. What did 2 years make difference, right? I think 2 years ago, there was what do you call China price, that Chinese company coming to the United States, you give 30% more higher. Mm-hmm. And now there's no sale sign. I think there's lots of fears from both countries to play that. So what do they say with the trade war? When two elephant fights, it's the grass gets hurt. And I think technology cooperations, and this is a problem like that. And I'll give you an example that despite you think China has AI, I think China's AI is mostly in consumer use. But I think the US is much better in enterprises and industrial AI. And then we were trying to put a consortium together, Japanese, Southeast Asia, Chinese, and to bring this technology to China, because we think they have so-called symbolic AI, which is not traditional machine learning, and it would be great if you put into chips, and then it can enable EV cars to drive autonomously, because today's AI is just not very much reliable. It's a black box. When they made a mistake, you don't know why make mistake, and I think. Look at the Boeing, maybe they have some these kind of issues. But when you have a symbolic AI, which is these companies out of California, and we were trying to do that, and because of the CFIUS, because of the export controls, and I think we found it's very, very difficult to do it because the political environment is there. And I think now U.S. has, 21 sectors that basically, they don't say the bar to China, but you really have to take a look at it. And that creates some difficulties for funds to make investment. And I know a large fund, they just raised almost $2 billion. They're actually, most of the money come from the United States, but because they have a few partners, they are not U.S. citizens. So they are not qualified as a U.S. fund. So when they make a company investment in a United States company, which they've been doing that for the last almost 10, 20 years, the company they invest is subject to some kind of regulations on that. And I think that is not very, very good for American companies seeking fundings. And especially today, technology has no borders. I think China today, lots of people get scared about China. It's not, I don't think China has the world's leading technologies. In consumer sector, yes. What I think is in everything about real estate, and spending, food, payments, even banking, Chinese are leading. But if you look at everything else, you just mentioned two sectors. China is good, AI and clean technology. What about others? China is not leading. You look at a world globalist innovation index. China as a country is ranked as 17th. But the consumer companies, you have Alibaba, you have Tencent, it's scary because their size is so huge. And so you hear a lot of that. But in terms of industry, China needs fundamental technologies. And I think China is still behind. That's why there's lots of companies trying to either buying or copying or using other ways to obtain technologies. But for US company, I think the technology today needs a market in order to promote innovations. You can't just sit in a room and say, I want to be innovative. So you have to really go to market where it has a needs. And where's the biggest needs? It's in China. This company called the BASF just announced a $10 billion US investment for the first time. Chinese government allowed them to have 100% refinery, $10 billion. And because that's a technology, and they put there and ask them why. They said 37% of chemical market is in China. And in 10 years, it's going to be 50. And you take a look you ask American company, large companies, their growth has really come from Chinese market. And sometimes they're the single largest market, and sometimes they're China versus the rest of the world. So I think barring technologies going to China to access Chinese market, it's not good for U.S. company.
Hi, my name is Patrick Lazada. I work at Albright Stonebridge Group. My question has to do with foreign multinationals doing research in China. AmCham Shanghai did a research survey of their members and found that only, I think, around 11.8% were doing research in China in cutting-edge areas, while most were focused primarily on adapting products that already existed globally to the China market. So why aren't multinationals, what's holding them back, in your view, from really chasing innovation?
Thank you. So whoever cares to answer.
I don't know that situation, but I think Google has a platform, and I think it's called TensorFlow. It's a middleware that allowing everybody using their technology to develop AI applications. And I think U.S. is very strong, and I think Microsoft also has this platform. Technology is really about application speed. And so I think now it's open innovation, we call co-innovation, is that if you supply people a platform that people will using it, it's like a GitHub, Microsoft just paid $7.8 billion to buy it. And China is what I call the place, just because sheer size, and there's a lot of activities in that area. So I think I hope but the Google is not actually operating in China in many big areas. So I think their platform is open for people to develop it. Just like Apple has apps, letting everybody to create apps to have people download. So I think that's lots of coming from the fear, and you really have to understand what level of AI is using. AI is software. What's the best software country in the world? It's the United States, especially enterprises softwares. And Chinese are not very good. I think we're catching up. I mean, China is catching up, but it's not very good in softwares. In terms of innovations, I think I asked some big companies, innovation in China, if you ask big companies, they committed, they said we're in China for China. And I add to on it for yourself, because, and the question is why large companies to be China? If you ask them, they tell you one, big market, secondly, the speed of commercialization or scale up, and third is digitalization. And they think that we have to be in China in order to understand and how fast the market is and how quickly. And I think the Chinese speed is scary.
Yeah.
Yeah.